In times of uncertainty, people follow the certain. This is Robbie Thomas with Realty Experts, bringing you the February 2024 market update and with details for the Bay Area. Let's look at about 50 screens. The common current thought is that the percentage of Americans who think prices will go down over the next 12 months. In January, it was about 37%. This is now January 2024, and in December of 2023, 24% of the population thought that the prices are going to correct. That is equal to 1 out of 4 still believe the prices will depreciate. But let's see what is actually happening. The current price appreciation in the Bay Area using historic data. The 49-year average monthly price movement. This is month to over month, 1973 to 2022. And you'll see in January it was 0.12, it reached a peak of 0.88 in May, and it fell to 0.12 in December. If you look at the 49-year average versus the 2023 price movement, month over month, not seasonally adjusted, you'll see that in January 2023, the price has actually dipped to 0.5% nationwide, while in November, it went down to 0.02, but it did reach a peak of 1.5 in the month of April. And this is from Case-Shiller. So if you look at the Case-Shiller prices month over month, percentage change in home value seasonally adjusted, you will see a dip of 0.2% in January 23, and you'll see a positive in the green of 0.2 in November of 2023. And if you look at the FHFA prices, which are government-backed loans, anything government-backed, you'll see that the month-over-month percentage change in home value seasonally adjusted in January 23 was 0.1 on the green, and it ended with in November with a 0.3 in the green. Percentage change in home values month over month, Case-Shiller versus the FHFA. If you compare them, you'll see in the 2023 Jan, 0.2% on the negative with the Case-Shiller, and the FHFA 0.1 green, and ended with 0.3 on the FHFA and 0.2 on the green for the Case-Shiller. And if you look at the November's year-over-year gain saw the largest growth in U.S. home prices in 23, with our national composite rising 5.1%. This is from Brian Luke, Head and Retail Digital Assets of S&P DGI. And home prices rose 6.6% from November 2022 to November 2023, and that's from FHFA, the data from FHFA. Let's look at the next one. Case-Shiller home price movement. So if you look at this one for the top 20 cities, the US national, it rose, nationwide rose about 5.1%. And for the 20 cities, it's only in Portland that they saw a minus 0.7% decline. Everything else was on the positive. Now let's look at the Freddie Mac. Data from Freddie Mac. Prices month over month percentage change in home values, also from January 23, is 0.3, and it ended in December with 0.6. And that's seasonally adjusted. Missed a slide. Percentage of home annual home appreciation from 1980 to 2023, seasonally adjusted within the 43-year average, you see about like 4.86%. As it's comparing from December to the previous December. That is from 1980 to 2023. You see it still ended 2023 in the green on the above average. Now look at the future price appreciation. So in 2024, the home price forecasts were like from average of all 8 is at 2.7 on the green, on the positive. Goldman Sachs at 5, MBA said 4.1, Zillow said 3.5, Fannie Mae said 3.2, Freddie Mac said 2.8, HPES said 2.4, NAR, National Association of Realtors, said 1.9, and Realtor.com is the only one which said minus 1.7 as the forecast in price dipping in 2024. So let's look at the next one. Now let's compare the original forecast versus the updated current forecast. So if you look at the original forecast of the same ones which I read earlier, initially Goldman Sachs has said original 1.9% appreciation, but now they said 5%. MBA said 1.1, now they're at 4.1. Zillow said zero point 0.2, now it's at 3.5. Fannie Mae said 2.8, but now they're saying 3.2. Freddie Mac said 2.6, now they're saying 2.8. HPES said 2.2, and now it's 2.4. And National Association of Realtors said zero point 0.7 initially, and now they're saying 1.7%. So yeah, it's still appreciating in their forecast. Let's also look at the mortgage rates because the majority of the market buys a home through a loan. So if the interest rates or the mortgage rates are higher, the prices will go lower because it removes the purchase power of the buyer. So let's look at the mortgage rates. So the 10-year yield and the spread above it. So basically, the mortgage rates are calculated based on the 10-year yield on the bonds, and there is a spread, which is this is what the lenders use as a buffer for their operating costs, fees, and that is tagged on to the base rate, which is at 4.02 currently. So this is the average, which is running as actual rate as of 2/2/24. Right now, today is the 13th, and it's gone a little lower, but not much. It's still holding above 6%, but below 6.92. The spread is not always consistent. It actually widens during periods of economic or geopolitical uncertainty, as has been the case in today's market because this year is election year and stuff kind of gets thrown, and there is a widening gap. And that comes from First, the deputy chief economist at First American. Primary driver of the increase in the yield over 2023 was inflation expectations. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year as investors demand to be compensated for that inflation risk into the future. And this is also from First American. So current rate of inflation, more important, the higher the expected future rates of inflation, the higher the yield on the 10-year. So there are elevated mortgage rates. There is reason to believe that the rate lock in effect will ease modestly this year as mortgage rates come down. And you could only imagine if they got below 6, and that's the key. See, even at 6, a lot of inventory that is there on the market is being absorbed, meaning it's getting sold, and prices are not correcting as much as you saw in the previous charts or slides that I'd shown. So when they actually, if and when they do, which is what they're expecting, the experts are expecting, if the interest rates go below 6, there'll be a big wave of new buyers enter the market, driving prices even higher because there's not much inventory. So continuing, and you could only imagine if they got below 6, then even more people would be again in the money, and homeowners will become less anchored to that low rate that they got a few years. Yeah, I mean, it's probably never going to go back to the threes for the 30-year mortgage, but it could go in the low fives. It also appears that mortgage rates are now falling again. They will almost certainly not fall to pandemic lows, although we may soon see rates under 6%, which would be low by pre-Great Recession standards. That is true. And this is from the senior economist, the Center for Economic Research. We anticipate that after the past several years of extreme volatility in interest rates, the 30-year fixed rate mortgage rate will continue to moderate over the course of 2024, moving towards a rate below 6% by year end. Yeah, that's the VP and chief economist from Fannie Mae. So you see, there's a consistent theme to these experts saying that it could drop below 6, and that's going to drive the market even higher. So let's look at the mortgage rate projections based off of the other institutions, and quarterly. So in the first quarter of 2024, December 23 was at 7%, and now it's at 6.4%. Quarter two projection, December was 6.8, and now the projection is 6.2. In quarter three of 24, 6.6, and in 2024, 6%. And fourth quarter, 6.5 in December 2023 was the projection, and now the projection in January 2024 is 5.8. So you can see a general consistent decline in mortgage rates. Let's look at the next one. Now let's look at the home sales. So one of the first things that we look at when you're looking at the market is how many days the houses are sitting on the market. So um, just like anything fresh, the faster it goes off the market, the faster the new inventory comes in and more buyers get into the market. So if a house is sitting on the market longer, then it's a clear indication that the market is unable to absorb that house at that price, and therefore it sits longer, no matter what the interest rates are, because the number of buyers are reducing and they're not willing to jump in because they're not comfortable with that price. So, with these elevated prices and elevated interest rates, in December, the average days on market was 29, which is still not bad because in 2019 it was 49 days on the market. Uh, and then during the pandemic number years, 2021, it kept dropping to like even 14 days average. That was the lowest. And now it's at 29, which is double, or 14. I mean, let's say even 15 days, and this is 30 days. You're getting the double the wait period. So it's still within a month properties move. That is pretty fast. If you look at the existing home sales since 2014, you can see a steady 5.5 million sales, and then there was a huge dip to 4 million during 2020, and then a spike during 20 after the 2020 towards the end to 6.5 million sales, then a small dip to 6 million, and then a kind of between 6.6 million and 6.5 million, and now a steady decline from 2022 to now under 4 million. So 2024, the projection is supposed to be in the 5.5 million, uh, with rising inventory if the sellers start putting their homes on the market. Analyzed in thousands, new home sales. They also peaked during 2020 and 2021 and started declining. Now, new home sales, percent of distribution by price range. Over 750,000, 4% of the homes got sold. And between 500 to 749,000, 14%. New homes are selling fast, median homes months from completion of sold. So, for example, once the house gets completed, the new homes still sell within 2.6 months. So, within the 3 month period, as soon as the house is completed, the house sells. So, there's still a big demand for new home buildings too, even if they have smaller square footage and they're building tri levels, buyers are still buying it. Next, we're looking at the total number of homes between 21, 2022, and 2023. And you can see there's a steady decline in 2021, 22, and 23 in comparison, simply because there was no inventory. And that is the current case too. Pending home sales, a general historical healthy number level would be about 100, but now it is way below the healthy number. So if there's no pending homes, that means there are no homes for sale. And that means a severe shortage in inventory. That means even with the elevated interest rates, the home prices are still not correcting. Um, and now let's look at if there's any distressed property. Some people say that there's a recession, and there's a lot of houses that are going to be in distress and foreclosures and short sales. But That hasn't happened yet. If you look at it from January of 2012 to December of or January end of 2023, there's a steady decline in foreclosures and short sales. So even that market is in short supply. Let's look at the home prices. Sales of existing homes in the West Coast, which this is where we're in California, it still goes up by 4.8%. The change in home prices year over year, not much. Change in home price year over year, 20-year composite. In November, it fell by 0.2%. It's hardly anything, it's negligible. Now, year over year change in prices, US home prices in November 2023. Now, the current is 5.2%, and the forecast is 2.5%. Let's look at the housing inventory. If you look at the inventory, this is the reason why the prices are not really correcting. The national average is minus 6.8% lower. The number of homes on the market is minus 6.8%. So even if there are buyers, there are no homes on the market to buy, hence a shortage. Months inventory, homes for sale from 2011 till today. You'll see about like uh, three and a half, about three and a half months of inventory. So any home on the market, even in a bad condition, any location, any square footage, um, any style, still sells within the 3.5 month period, which is still a super seller's market. This is the same thing, 3.2. And that report is from NAR, which is National Association of Realtors. Year-over-year inventory levels, December, you saw a small increase to 4.2%. But if you look from May to October, the inventory fell from minus 6.1 to a peak of 16, to 14.6, and then started rebounding to minus 5.7, and in November, a small bump of 0.9%, and this slightly higher number of 4.2 by December. New home monthly inventory, and here's what you see. In December, you saw up to 8.2. That's not much, but it still is a small increase. Non-seasonally adjusted, you get from 2022 to 2023, and you can see there was more homes on the market in 2022, represented by the dark blue here. And I mean, although there's a slight increment, it's still lesser in comparison to 2022. Now let's look at the buyer demand statistics. Showing index. So this data comes from Showing Time, which is an app that tracks how many people actually enter the homes to see the homes. So if they're represented by a buyer, by an agent, the agent has to open the app to enter the house, and that's how we get this information. So it shows there was a peak in 2021 for home viewing at 176.1, and then a decline to 121.6. But it's only around a 50 something point difference, but it's still elevated. That means there's still serious buyers who are looking to buy even with the higher interest rates, only because there's no inventory. They want to keep looking until they find something. Let's look at the mortgage rates again. The 30-year fixed from January 2016 till today is about, as I discussed that earlier, it is definitely not 6.92, and but it's still elevated over 6%. And these are the projections or the mortgage rate projections for from January 2023. Fannie Mae, MBA, NAR, and the average of all three. So all three of them actually show over 6%. And the mortgage rate, the 30-year fixed, are declining, but it's somewhere around the 6.1% in expected to be by third quarter of 2024. And that's the same data, but in a graph. And now let's look at the mortgage credit availability, because that will show how much borrowers can actually get a loan. So if they qualify, they do get a loan, but it also depends on what kind of credit is available for them, what kind of mortgage is available for them. And you can see a steady decline in December 2023. So there are buyers, but the qualifications are much higher, requirements are much higher. And this is a nice chart from MBA that shows what the lending standards still under control. Are the lending standards much more tighter or looser? And you can see they've held steady over the last few years since 2008. The housing bubble happened over here in 2006, 2007. That time, that's when all the rating was 868.7. And then they started tightening the standards, and ever since they've been tightening the standard, now it's at 92.1. That means the lending standards are very tight. So in summation, just stay focused if you are a buyer and never give up. Just try every single thing that you can by looking at all the houses on the market. Try and find properties that are not on the market. If you have an interest like that, do give me a call at 510-374-2264. If you're a seller, do let me know. I have a buyer pool and who would like to get into a home right now without giving you any inconvenience. Either ways, just give me a call. You can watch my updates on YouTube at the Bay Area Downsizer. If you like the video, please subscribe and hit notifications. Thank you and have a wonderful day. Bye.